Welcome to the second session of FinTech University, Nelson Mullins program to introduce attendees to the world of FinTech, or financial technology, which is the convergence of financial services firms, be they traditional firms like banks and trading firms and brokerage firms, and innovators, which are building new technology to transform the financial services industry. These sessions are designed to introduce the attendees to the various aspects of FinTech. Today's session will be focusing on payment processing and the regulation of payment processing. I'm Rick Levine. I'm the chair of the FinTech and Regulation practice at Nelson Mullins. My practice focuses on the securities and regulatory side of FinTech. I'm joined by my esteemed colleague, Craig Mazzaro, who is on our bank reg and payment processing side of the FinTech practice. We will be taking questions throughout the presentation, and we'll have a Q&A session at the end. Please feel free to submit your questions throughout. Also, please note that for continuing education purposes, we will be giving you words that you will have to submit in order to receive continuing education credits. So please pay attention to those words. Make sure you write them down so that you can submit them at the appropriate time. But again, thank you for joining us, and I'll turn it over to Craig.
Thanks, Rick. Good afternoon, everybody. I think today, to start off, we wanted to cover what we mean by FinTech in the payment space, and what we were seeing in terms of client needs and opportunities within the space. We want to take a look at the fundamental shift that we're seeing in payments as we move more towards digital solutions, what those solutions look like. For example, mobile payments, digital wallets. We also want to take a look at crypto payment space and things like the Facebook DIEM coin, or formerly known as the LIBRA coin. We also want to take a look at new technology that we're seeing in the space, as well as how the same regulatory framework around the financial services industry is impacting this new technology, and what we're seeing from our clients and their need to adopt and pivot within the space. We also want to keep on touching upon the old Blockbuster Netflix analogy as it would be applied to the payment space. The disruption in payments is creating a completely new customer experience and user experience, not only for our financial services clients, but also for a host of other industries that our clients work within. We are routinely approached by people in almost all industries across the firm, how they're interacting with their commercial consumers, how they're interacting with their consumers on a payments level, and what that experience for their consumers looks like. That not necessarily is always through their bank. Sometimes it's with their own individual IT solutions or their own strategic partnerships. Start off, the goal everyone is looking at or towards is real-time payments and ease of use. Today, there will be those that say they have real-time payment solutions. It's important to note here that 90% of those quote-unquote real-time payment solutions in the industry are not actually real-time. Real-time payments is looked upon as the gold standard within the industry. We see this standard in other countries. A large driver in the US's lag in innovation here is the regulatory framework that we're subject to here in the US. Almost all of our regulations governing payments date back to the 60s, 70s, some coming out of the 80s, and they present challenges as the technology or even the means of moving the funds weren't even contemplated when the regulations were written. Or weren't even on the horizon when they were written. We don't address things like who bears the risk of fraud, who's responsible for misdirected payments in instances where the payments are instantaneous, where someone can direct and settle a payment within a matter of seconds from their phone. Those weren't contemplated when the regs were written, and a lot of it is still in a gray area when you're building out this technology or deploying this technology within your clients' consumer-facing portals. We have clients at the firm who are routinely stunned by the lift that it takes to have their banking and payment solutions they developed under foreign regulatory regimes retooled for US compliance. While admittedly it's a hurdle, we are seeing a relentless push to bring the US in line with the global payment landscapes. We're starting to see more and more of a global economy with solutions developed in Europe, or we have a large Australian client right now that's bringing these solutions into the US, and we're assisting with the regulatory build and the licensure of those entities under the US framework. And it's known that we will get there. Our clients realize that those that do it first will be the winners of the most market share and the winners within the industry's transformation. It's also important, again, like I said, to note here when we're talking about real-time payments, we have a lot of solutions out there that are presented to the consumer or presented to the businesses or our clients as real-time solutions. A lot of that risk is shouldered by the entity that's presenting that as real time. The payment may show up in real time as a credit within whomever is the payors or the payees settlement on their banking statements. But in reality, those payments are taking 2 or 3 days to settle, and that risk is then assigned within the contractual relationship with your payment partner. So this is something we always bring up with our clients. Fundamental shifts. So we want to take a minute and look at the trends in non-cash payments over the last decade or so. So over the past 10 years, you see here the slide on the screen, non-prepaid debit cards is really growing exponentially. We are still seeing credit cards increase. ACH debit transfers and credit transfers have remained consistent, and we're seeing checks, as would be expected, just weaning out and becoming less and less utilized. Outside the U.S., we have clients that are moving into the U.S. territory and are stunned that we're actually still using checks as a method of payment here in the U.S. Important to note here too that the non-prepaid debit card solutions and the payment solutions, the digital payment solutions that are that solid blue line, that is expected to continue to climb coming out of COVID. It was supercharged by COVID. You'll see that as a theme as we go through these slides today as well. So, that's 2018. In 2019, 20, and 21, it's continued its exponential growth. Also, this is where our clients, not only those within the financial services industries, but those that are processing payments or accepting payments on behalf of their clients, should be focusing. It's not enough these days just to take credit cards or just to have an ACH ability. We have clients that are expecting their consumers to have the ability to pay in their living room, out on the street, from anywhere, as their sales force or their representative is armed with just a cell phone. Here too, we want to talk about the trends in distribution of general purpose card payments. Again, here we see exponential growth as you get towards 2018. With remote and in-person looking to remote to overtake the in-person payment processing. So when you think about payments, it's not just the payments at a point of sale. A lot of us think of handing over your phone or handing over your actual debit or credit card to have that payment processed at the point of sale. A lot of the payment transactions that are occurring, and you can see this is growing from 2012 all the way to 2018, are those that are either done in-app or done on a website, as you're surfing the internet on your phone through just pay with Apple Pay, just click here to pay. Those payments are becoming a large portion of the payments that are processed in the U.S., and that's just not for entertainment purposes, but any shopping that's being done, any payment that's being done inside of the clients' industries. We have clients that are in the shipping industry, in trucking, all those payments when their drivers are out and filling up their cars with filling up the trucks with gas or fuel, or weigh stations. Those payments need to be processed. Those industries or those clients that are adopting the most friendly ways of processing those payments are the ones that are growing the fastest. Moving on, we also have a shift to digital at all levels. So here, the graph on the left, we have all the white space is those the population of the U.S. that has access to all matters of financial services, and those that are excluded just from financially exclusion only is orange, green is digital and financially excluded, and blue is digital only. You do see that underbanked and unbanked have a large growth opportunity for those in the payment space. We like to say that if you're a forward-thinking financial institution or forward-thinking FinTech, that is a huge opportunity. You can attack the unbanked, attack the underbanked. And it's also good to notate here that the regulators are aware of this. So not only are you having a push from the industry saying, hey, look, the US is lagging here behind our global counterparts or European counterparts in the payment space, but you also have the regulators beginning to understand that the unbanked and the underbanked now have an opportunity to be brought into the US financial services system through FinTech. And part of that is this payments industry. More people have access to a phone than, can conveniently walk to a US depository branch. And that's not lost on the regulators. So we do have a lot of financial services clients that, are leveraging their FinTech partnerships, their payment programs or their payment products, their virtual cards, their payment digital wallet solutions as going after an unbanked or underbanked population. They're deploying that within their CRA programs. They're deploying that within their bank application mergers, saying, this is part of our future state. And it's getting good traction with the regulators. We'll see in later slides today what the regulators are looking at when they're looking to aggregate sandboxes or forward tech programs where our clients are building various FinTech applications or FinTech partnerships under the supervision of the regulators. On the right here, we wanted to showcase, how people are spending in a cashless economy. So we do see that a majority of people still traditionally use credit card, debit cards, the actual physical plastic cards. We do want to make, the analogy here that that card, in our opinion, is the CD of the mid-90s. It's still being used, but we're on the verge of it becoming extinct as more and more people, adopt and become comfortable with not only online banking, but banking through their phone, payments through their phone, mobile payments, and digital and cryptocurrencies. We did want to point out here in that last bar on the right graph, 24% of people are spending with digital or cryptocurrencies, which is surprising to a lot of people when they first hear about it because it's a younger demographic that are utilizing those solutions for payments, but it is rapidly rising. We see, especially on the REGS side of the house, we'll see clients come to us every day that are looking to disrupt the payments industries using various cryptocurrency or various blockchain solutions. And it is gaining traction. It's gaining traction from not only the regulators, but gaining traction within the U.S. population in general. Important to note there too is that 20% of this in that same graph said they never intend to use that, but that is aging out of the population. The early adopters, those 30 and below, have already adopted this technology. You're starting to go after other market share for not only financial service clients, but clients in general. They will start to this technology will gain traction and will gain dominance in the US. Here, I want to talk about the fact that not all mobile payments are created equal. There are different solutions in mobile payment spaces, for example. Mobile proximity payments are near field reading, where you have your phone in your hand and you put your passcode in and tap the phone to the point of sale the merchant's payment processor hardware. Think Apple Pay for this or Google Pay. Then you have mobile web payments where you're in the browser, your internet browser, or within the application, and then you have the capability through your mobile device to conduct a card not present transaction, sometimes referred to mobile commerce or M-commerce. Here, think of payments or purchases that you make on Instagram. You also have mobile remote payments where you're using your mobile device, phone, to initiate a transaction with a merchant who does not have the ability to process a physical card. Think here the Buy Now feature on the Amazon Prime app, or if your kid is in a game on your phone, they're asking to spend $1.99 to buy whatever uniform they want to use. All of that is a mobile remote payment. Then you have a mobile POS or point of sale, which allows the mobile device to be used at merchant point of sale terminals. Think Square here or Stripe. Then you have peer-to-peer payments. Think Zelle or Venmo. So when you're thinking about mobile payments or digital wallets or mobile or digital payment technology, don't think that it's you know, one size fits all. So we have clients in various industry silos that come to us asking, you know, what the options are, and the partnerships that are out there or the technology that they can deploy are almost limitless in what the solutions are. And if you're thinking it from a regulatory perspective, that's also problematic because you have you know, the space is growing in all directions. You have tech companies building out payment solutions. You have banks partnering with payment processors for payment solutions. You have people that are trying to build payment networks that are outside the traditional depository structures. So the regulators are trying to, you know, stay ahead of it, but you're not building in one direction. You're kind of building out in all directions at one time. From a regulatory perspective, that does become problematic. Here we want to showcase the jump in mobile wallets. Again, you can see why this is becoming problematic from a regulatory perspective, because you have it growing at an exponential rate. You know, the digital wallets are still lagging behind traditional methods of payment. However, as we said before, those are expected to grow massively. But you can see the various methods on the right side. And this is another example of how, you know, it's growing in all directions. You have things like Apple Pay, Venmo, Zelle. I saw a meme the other day where it's two people talking to one another on Instagram, and, you know, can you pay me? Can you Venmo with that? No, I don't have Venmo. Can you Zelle it to me? You know, my Zelle account doesn't work. It's almost comical how many solutions there are out there. And you know, sometimes it's hard to get, you know, people on the same platform. When you think about that from a regulatory perspective, the regulator, it's hard to get their arms around what the limitations are within each platform, or what the ability is within each platform. So when you're deploying these solutions, you have to think about that as well. How are the existing regs applied to this? Is this payment solution you know, significant enough where it's been vetted? Has someone looked at it from their side? Or do you even have do they have the subject matter expertise to be aware of what kind of regulatory risk that they're presenting to your client when they're partnering with them? It's all things that we have to think about, not only with our financial services clients, but also with our clients that are partnering with these entities. They have to diligence them and understand what, you know, kind of regulatory risk they're taking on by onboarding the solution.
Hey, Craig, it's interesting to me because when you look at the list, you start seeing the convergence of technology firms. And I think this slide may be a little bit old. You've got Facebook on there, you've got Square, Zelle, Google, Apple. You know, these are people used to think of Google and Apple as technology firms, and Facebook is a social media firm, a technology firm, not a financial services firm. But we're starting to see this convergence, you know, Samsung Pay as well. So this slide, you know, demonstrates how the convergence of the technology side of the world and the financial services side of the world, you know, Silicon Valley and New York doing more work together rather than just New York being the bankers to Silicon Valley.
Yeah, the line between, you know, bank, payment company, and tech company is becoming really blurred, and it's important to note that you have to understand what side of that line you're on to understand what's portion of the risk you're onboarding when you decide to deploy these solutions. Again, here, just talking about the uptick in mobile wallets, the use of it, including this information here because we want to state that, you know, mobile wallets, again, are gaining traction. 24% of consumers are saying that they're using it on a daily basis, with 40% of people saying that they're using it at least once or twice a week. Again, we want to make the point here that a lot of people think that mobile wallets are your phone, you know, with your credit card on it, and you're tapping it at the gas station, or you're tapping it at, you know, your whatever merchant you're in. But it's not. You know, there's been an explosion in online gaming or even the NFT spaces. If you're looking at how this is all being paid for, if you're, you know, buying a new game or buying the next level or buying whatever the game is selling, or online retailers that literally have no other way but to pay through a digital wallet, that payment space is becoming exponentially large as well. So you have to realize that it's not just having your phone and you know, tapping it somewhere, but also when you're on the internet, or, you know, you're just browsing through the internet, what you're doing in there virtually, those payments are all real payments. They're being processed and settled, you know, on a daily basis. And if your client is out there within these spaces, it's important to note, you know, who they're partnering with to process those payments. Again, here we want to just, we mentioned it earlier, but the impact on COVID on contactless payments. Here, over the last decade, we touched on it earlier, but the impact of COVID on contactless payments has really made the growth exponential. The U.S. population, and the global population has now become more aware of surface interactions, and the trend seems to continue as if you can have everything on your phone, no longer need to interact on a physical level with a PIN pad or a cashier. You saw Amazon has now deployed their new cashless lanes, or they have multiple stores now where you just fill up your cart and walk out. Those payment solutions are all other products that are out there, or new technology that's being deployed. How it's being charged to your Amazon account, but that will become the customer or user experience that is expected. If your client is not trending towards these developments or trending towards this new technology, they're going to be left behind. Again, referencing the Blockbuster Netflix analogy, where you want to be that entity that is making the user experience the best out there, the most user friendly, the most ease of deployment. Mobile point of sale. So here we want to make sure that we're again making it very clear that the squares of the world have really made a gig economy possible. You're moving away from required hardware solutions. You no longer see those big cumbersome payment terminals at your point of sale. You can literally have someone in your home, a street, a market vendor, a food truck, businesses of all sizes. And it's not just the the small businesses and entrepreneurs that are deploying this. It's large scale businesses that are when you walk into an Apple store, they're processing the payments. There is no cashier. They're processing the payments by the person who helped you sell the technology. Again, it's becoming the anticipated ease by the consumer. They don't want to go wait on a different line and have to just see someone to make the payment. They want these to be quick and painless. And it's really revolutionizing any industry where payments are accepted and processed. You're going to have to kind of adopt these partners or kind of look to pivot towards the new technology if you want to stay competitive. I just want to quickly address this, biometrics. We have various consumers saying that they're fine with biometrics, whether it's fingerprint, voice, facial, eye scan. It's deployed on your mobile devices or your computers already. We're starting to see this come into more and more on the payment side. It's not widely adopted yet, but we believe it soon will be. How it's going to be deployed, no one knows. What the regulations will be around that is still unknown. It should cut down on fraud, but this is another aspect where our regulators aren't keeping ahead or up to date with the possible deployment of new technology. And you see it in industries where you not necessarily aren't regulated, like for your phone, for example, your thumbprint or whatever it is, the face recognition to open your phone. While that's deployed very easily, it's very rarely used in payments, but it is on its way.
Craig, it's funny that you mentioned that, because I remember at a conference a number of years ago in Singapore, had Payment Asia for one of the biggest banks in the world. We were talking about how this is the future of banking, smartphones versus credit cards. And I remember asking her, I said, do you truly believe that is a ATM more secure than a phone? And she said, no, a phone is much more secure because of biometrics, thumbprint recognition, facial recognition, built-in encryption. And she said the magnetic strip is an 80-year-old card, the microchip is a 50-year-old technology. And they said that they believe that biometrics and facial recognition, thumbprint recognition will actually dramatically reduce fraud in financial services, and particularly in payment processing. So I do think the big banks, the traditional credit card processors, are definitely in support of this from what we've seen.
Yeah, that's a great point, Rick. I think it's worth mentioning again. Like, a lot of people think of FinTech as just an ease of user experience, or not as secure as traditional banking, which just isn't true. To Rick's point, you have a chip in your card. There are more sophisticated ways to ensure that the person processing the payment is the person that they're claiming to be, and you see this across all silos within FinTech. The majority of the U.S. population might be wary of making a payment online or using cryptocurrency because they think it's not as secure. But in reality, the opposite is true. The technology really does, enable regulators to get more comfort around almost every aspect of the regulation, whether it's the BSA AML or KYC, know your customer, where you're identifying an individual. A lot of the fintech solutions that we work regularly here with Nelson Mullins, the technology itself would be a benefit for the banking industry if and when it's widely adopted.
Hey, I'm going to go ahead and provide the password, the first CLE password for today. The first password is commerce, COMMERCE, and I'll provide the second one in a little while.
Thank you, Clara. I'm just going to quickly go through this slide because I think I'm falling a little bit behind on the slide count in our time. It's the growing role of voice payments, just as you have biometrics and digital wallets. Another sector of the technology being deployed in payments is voice payments. Whether you're talking to Alexa or Siri or buying something through a home assistant, the ability to make these payments is creating its own regulatory risks. And we have here what people are doing through smart speaker payments and what part of the industry they're doing. Are they ordering a meal? Are they playing music or streaming videos? Are they buying that content? And how those payments are being deployed. Rick, do you want to take this one for just a quick case study on the Facebook case?
Sure. So it's been widely reported that Facebook and a group of other institutions wanted to launch a digital asset or cryptocurrency, originally called LIBRA and now called DIEM. And the purpose of the model is to promote better payment processing and efficiency of movement of funds. Now, the objective is quite ambitious. Unfortunately, the rollout was met with a fair degree of hyper scrutiny by members of Congress of both parties. And I think some of that may have been that the rollout, unfortunately, was rolled out in a manner that Silicon Valley refers to as move fast and break things, rather than socializing it with the members of Congress and the regulators more extensively than what they would have liked. I believe that there was a desire to move the process forward and to launch this digital asset. It is a promising move by one of the largest institutions in the world by number of users, Facebook. If Facebook chose to be a bank, it would be the largest bank in the world, more than likely, by virtue of just how many clients or subscribers to its system that it has. But unfortunately, when you look at creating a product that is a digital asset, it raises the attention of regulators all over the world. And the issue with DIEM was that originally it was going to be launched out of Switzerland. That met with a fair amount of consternation from members of Congress and the regulators about the ability to supervise DIEM. That has now changed. The DIEM consortium has said that they're coming together, they're going to launch it in the United States, they're going to comply with applicable US laws, and the laws that people are most worried about on Capitol Hill and in Washington, DC are laws with respect to regulating currency movements, such as money service businesses or money transmitters, and the Bank Secrecy Act, and then also possibly the securities laws. The United States Treasury, former chairman of the Fed, Janet Yellen, has said that she is a fan of the technology behind many digital assets, what's called blockchain or distributed ledger, but she's not a fan of cryptocurrencies that were sold illegally. So I think as we look at the growth of DIEM and other digital assets and payment processing systems, the regulators will be paying very close attention. So we would counsel all of our clients that are looking to either launch a digital asset, launch a digital asset platform for exchanging digital assets or cryptocurrency into traditional currency, or looking to participate in a group doing so, that they really need good counsel to work with them on whether that product will be deemed a security, a commodity, or a currency, and whether it will be subject to regulation by the bank regulators at the state and federal level, the Department of the Treasury through FinTech and the Financial Crimes Enforcement Network, the Securities Exchange Commission, or the Commodity Futures Trading Commission. But DIEM is a great example of when you launch something and you maybe haven't fully vetted those issues, with the appropriate regulators, you are going to face massive blowback.
And with that, we're going to move into the regulation of payments, but this might be a good time to bring it up. With cryptocurrency and the payment space, I said before, you get this idea or notion in the U.S. that it's somehow less secure or somehow enables financial crime. Rick, I thought it might be good to mention the vendor that you had brought on, a new client that Rick brought to the firm, that is a vendor to both financial institutions and blockchain technology companies, where they offer an investigative tool or an identity tool. And people think that if you make payments with cryptocurrencies, that it's completely anonymous. It's it's a widely held belief sometimes in the U.S. This vendor was showing us what their technology does, and in real time they could track a specific coin on the Bitcoin blockchain or the Cardano or Ethereum blockchain, and what that coin, when and where it was used and how it transferred all the way back to its original mining. And when you think about that from a regulatory perspective, where I think you said Janet Yellen was saying that she's a fan of cryptocurrency, from a government or regulatory perspective, that is an insane level of details for a bank or the government to be aware of. We're constantly on the financial services side saying, do you know where these payments are coming from? Do you know, who's associated with these deposits? And you have various programs and various software deployed in order to catch that. On a cryptocurrency or digital asset, you can track that fairly easily and see the whole history. It'd be like seeing where the serial number of a dollar that you deposited has been since it was printed out of the treasury. It's just an interesting development. I thought it worth mentioning.
Yeah, Craig, on that point, we always tell people that if you're using a blockchain-based currency to launder money, you're an idiot, because it is a wonderful audit trail. And that's why the Chinese government has designed their own digital asset version of their currency, the yuan, the digital yuan, while the European Central Bank is looking at creating a digital asset euro, and while the American Federal Reserve and the Treasury are looking at the same thing. So as Craig pointed out correctly, we'll talk about in the next session that we're going to do at FinTech University about blockchain and digital assets and trading platforms. But please keep in mind that digital assets built on blockchain are not anonymous. It's a pseudonym, just like your bank account number at your bank, which appears on the bottom of a check. And once that pseudonym is cracked, anybody can know who you are. So the companies that we work with, some of them are working with the federal government and actually have been helping the federal government track down activities, including activities by nefarious actors who shut down the flow of U.S. oil and gas, which impacted the eastern seaboard, where they were able to track who these people were, who these extortionists were. So we'll have a next session on that. But Craig, let's turn it back over to you.
Thank you. So what are some of the challenges here? When I say that, some of the FinTech entities that, that we're onboarding as clients, or those that your clients may want to partner with, a lot of them aren't traditional payments companies or aren't, traditional banking or financial institutions. So it's, especially here in the U.S., and I said, other parts of the world are beating the U.S. to, revolutionize the payment industries. Part of that is due to our regulatory regime. So here we just have a quick graph of what a FinTech, what kind of regulatory exposure they have. They have the state financial regulators, FinCEN, OFAC, the FTC, the CFPB, the depositories regulators, the FDIC, the OCC, the Fed, the NCUA. When they're faced with this, it's a lot to think about, and a lot of the time they're tech focused. They're not necessarily thinking about the financial services regulatory aspect. They're just building out the tech or deploying the tech. And that's something to think about, whether your client is partnering with these fintechs or whether you're looking at it from a financial services partnership perspective, how your compliance system or how your regulatory controls are going to overlay with this fintech. Have you vetted the fintech? Have you looked at their internal controls? Do they understand what kind of regulatory risk that they're exposed to, or do they just have really good software and really good tech? Here we want to touch on, what it's like for payment companies or a fintech to go at it alone. So we're starting to get into the regulation of fintech and, how these payment companies or these fintech entities that are offering payment services, what their hurdles are. So, they have a very good approach to the user aggregation, their marketing, their ease of use, their customer experience. Traditionally areas where our banking clients have failed to excel. So, problem there is where they do have all those attributes. What they are commonly not as good at as the banks are their regulatory oversight. They're not used to the compliance controls that are mandated by the regulators that we just mentioned. So we start to see a lot of partnerships going between banks and fintechs and when it's deployed, whether it's the fintech leveraging the bank for their licensure or oversight, or the bank leveraging the fintech for their customer base, their deposit aggregation, or their payment processing ability. Part of that is partnering with an MSP. So here we have, part of the state problem, right? The tech company that's built a great payment solution doesn't even realize sometimes that they've run into money transmission issues on a state-by-state level. So they may need to obtain 50 different state licensures, or they may need to partner with a bank quickly in order to avoid that regulatory liability and avoid those issues. Here, just gonna start to move a little bit quicker in it because we have addressed bank partnerships in the past in this series, but part of leveraging the fintech's payments solutions or ease of customer experience. We see banks, out there trying to grab market share by finding the best fintechs out there to partner with for payments or for money transmission, or the fintech may be using payments, or deploying a solution for payments that is so user-friendly that they have a ridiculous amount of payments flowing through their technology on a daily basis, which is very attractive for our banking clients, or deposit base, or just the transaction base, or revenue base, especially in an environment, with interest rates so low. They're all looking for revenue from different sources, and you have, an area within the fintech payment space that's growing exponentially. So the banks are out there looking for those partnerships a lot. New tech, same regs. We do want to touch upon the fact, again, that, as we said earlier, a lot of these regulations are written with the technology that's now available, but they weren't contemplated at all. You weren't thinking about, paying with your mobile phone in 1980 when some of these were written, or 1970 when some of these were written. But the regulatory framework still does apply. And a lot of, the gray area here is who do they apply to? Whose responsibility is it? For a BSA, AML, KYC perspective, is it the fintech's job to make sure that those making the payment, are who they say they are? Or is it, if they're partnering with the bank, is it the bank's job? Who's looking at the UDAP concerns? From a money transmission perspective, have you looked at the funds flow? See, if your partner, or if you are the entity that's processing some of these payments or funds, are you a money transmitter by definition? Or have you gotten an exclusion from the money transmission state regs on a state-by-state basis? Rick and I have a client now where a part of the onboarding the client is being held up by, is this person a money transmitter in every state in the nation? We want to deploy that solution. I believe on this client, it's an ATM network, but it's unknown if they had the, foresight to decide if they were a money transmitter on a state-by-state basis, and what kind of diligence can they produce to us to prove that they have thought about that and they do have the proper exclusions. So here, due diligence required for banks. So banks can partner with payment providers to expand, again, the product offerings or functionality, but they have to deploy proper oversight, right? So like here at Nelson Mullins, if we have a smaller banking client, they may be looking to grow through, payment partnerships like a virtual card or, whatever payment solution is. There's other partnerships that are out there, but, we're talking about payments today, so that's what we're going to talk about in this particular slide. But can the bank demonstrate that they have subject matter expertise? Can they monitor the partner on a schedule that's reasonable, that, where they're going to find the risks that are out there? Are they going to jump into a space? We've had clients that are partnering with payment fintechs that are doing cross-border transactions, and had a very sophisticated OFAC and BSA risk profile, but the bank itself was very small. The regulators don't like that. They don't care if the bank is small, so long as the compliance controls deployed with the partnerships are very big. You're going to start to see this more and more as banks are looking to grow digitally rather than physically. So they might not have a big branch presence, or they might not have a big footprint, or they might have an overall small FTE cost where it's only a couple hundred people within the bank, but they're processing hundreds of millions or billions of dollars in payments. So when you have those entities being built, you want to make sure that you're building them with the regulatory and compliance needs of a much larger, much more sophisticated entity than physically they are, or from an FTE perspective they are. You might have a compliance system or a BSA department that's staffed for a bank of $20–40 billion when it's a one branch bank. If you're doing billions of dollars in payments that are moving all across the globe. For the payment providers as well, there's due diligence requirements, right? Like you want to make sure, and this is kind of a new area of concern for some of the payment fintechs that are out there. What is the client that you signed up doing? Are they being deceptive? Are they breaking the law in any way? By processing payments or making that the technology easy for the client, you want to make sure that you can prove to a regulator, whether you're the bank that's behind this fintech, or if you're a licensed fintech that's in the payment space, if you're a licensed money transmitter, you're seeing more and more be questioned of, well, who are the clients? What kind of BSA AML do you have deployed? The technology is making it such that you can be much larger than your presence. So you want to make sure that you have a line of sight into who you're assisting with payments. The case that we call out here is MOB, where the Qualpay ignored numerous signs that Mobi or MOB was a fraudulent business. And they just didn't have a red flags policy internally that was adequate to flag the transactions that were being processed, or flag the complaints that were being processed, or the chargebacks. And the regulator came in and said, that's a violation. You have to be more aware of that. So currently, regulatory innovation. So where are the various financial services regulators in the payment space? The CFPB has stated that they have, they are aware of the need for faster payments here in the U.S. They've released various pieces of guidance. They said it in their spring and fall regulatory updates. But they do have some strong concerns. So a lot of the principles for consumer protections around faster payments are listed here. So they want consumer control over the payment, data and privacy concerns to be addressed, fraud and error resolution protection built in. That fraud and error resolution protection is what we talked about again in real-time payments. Who bears that risk? Transparency, where are those payments going? When will it settle? Cost, they want to make sure that the underbanked and unbanked are being given access to this. They don't want people paying through the nose for the technology just because it's the first or only out there. Access, again, underbanked and unbanked. Funds availability, when will it become available? If you're saying it's real time, can they access those funds in real time, or are they just seeing a credit on their account? Security and payment credential value, are you deploying proper controls around the security of the network or the payment rails that you're building, and strong accountability mechanisms that effectively curtail system misuse. What they mean there is, do you have the compliance systems and the compliance controls deployed that are going to properly oversee a network that you're building, or if you're a bank, a network that you're partnering with. Here we want to talk about the OCC's push into the payment space, where they, the OCC had a FinTech charter or a FinTech charter application process, and back in 2016 that started. It got marred in a bunch of litigation in New York. The state regulators did not like the fact that the OCC was going to allow a FinTech charter. That takes a lot of revenue away from the state regulators. We did have Brian Brooks as the acting comptroller. When did he leave, Rick?
He left right at the turn of the year when the new administration came in, and people have to remember Brian before that had been the general counsel of Coinbase. But much of what Brian was rolling out as the comptroller of the currency has now either been rolled back or put on hold, while the new acting comptroller of the currency says that the agency is going to go back and revisit what was proposed under Brooks or what was put forward under Brooks. So the ability to get a FinTech charter, as Craig pointed out, is probably caught up in a quagmire of the courts in the courts where the comptroller of the currency or the OCC is litigating with state regulators over the authority of the OCC even to create a FinTech charter, claiming that state law was not officially preempted by the enabling statute. So the OCC is caught up in a bit of a, I would say, a reconsideration of actions taken by the previous administration.
And to explain the push here, for those of you that aren't aware, Brian Brooks was a very technology-focused comptroller, very supportive of cryptocurrencies, digital assets, and payment technology. And from his view, which I personally agree with, the fact that the U.S. is lagging in innovation in the payment space, again, is primarily driven by the regulatory framework that we have here in the U.S. If you look at that barrier of entry, if you want to be a payments company and you call up Nelson Mullins and say, hey, what do I need, to bring this to the U.S.? We're going to tell you that, we have to look at your licensing requirements in 50 states. You're going to be subject to 50 different state exams because you don't have a federal charter. The obvious first question there is, well, how do I get a federal charter? You either partner with the bank, you buy a bank, or, Brian Brooks's approach here was, let's get them the ability to get a charter. Have one set of regulations govern them instead of 50. Have one exam instead of 50. But as Rick said, that's all been put on hold, and we're kind of in a wait and see pattern here to see what the next comptroller, how they push the directives of the OCC. Here, Square was an alternative pathway. Square took the approach of saying, all right, hey, look, if we're not going to go the OCC route of the FinTech charter or the payments charter, why don't we just go ahead and get a bank? So they got an ILC, an industrial loan charter coming out of Utah. They're just starting to use it this year. The bank hasn't launched yet, I don't believe, Rick, but we're starting to see activity in that space with that charter. Square is still operating under their old licensing. They haven't moved everything into the ILC, but it'll be interesting to see how that develops for the rest of 2021 and into next year.
Craig, that's almost like a back to the future model, though, isn't it? Because a lot of finance companies, automotive finance and others, I think even Goldman Sachs have a ILC, Utah chartered institutions that they've been using for decades.
Yep, yeah, it's interesting that that they're going back to that playbook on the FinTech side. But you're starting to see some too in California. A lot of FinTechs are just going after straight up charters, whether it's a state charter or a federal charter. They're going that route. If the OCC is not going to give them a specific FinTech charter or a specific payments charter, they're going to go ahead and make an application as a bank. It is a higher barrier of entry, but once they get it, they'll be allowed to kind of run wild with their development, so long as they staff it correctly and run it with the same oversight as traditional depository here in the U.S. But our banking clients are aware of this, and we should be aware of it. That is a threat to them. So if they're not going to partner with these FinTechs, or they're not going to build out their own digital or FinTech quote unquote solutions in-house, they're going to be continually bombarded with the threat of these FinTechs, or the threat of the payment companies going after charters, or getting more secure in their ability to go at it alone. Again, here the OCC, rulemaking on digital technology innovation. The OCC is one of the regulators that continually pushes forward. They're constantly saying that they're behind the use of artificial intelligence, distributed ledgers, crypto, more so under Brian Brooks than the new regime, but still the guidance and the tone coming out is that they're aware of the shift in the landscape and that real-time payments is needed, and that the U.S. is behind other parts of the globe in this space. So we're constantly seeing developments here as well. Start to move through these a little bit faster. Same thing here from the FDIC, the FDI tech. Each individual regulator has, at this point, created their own technology, either sandbox or technology department, FinTech department, that is looking at these advancements in technologies, advancements in payments, and kind of tasked with the building out of that. See if they can get a little bit ahead of the technology that's starting to be deployed. Where they were so far behind with the regulations that are currently out there, they're all trying to get a foothold. Same thing here, the FDIC multifaceted approach to fintech developments, what they're doing there, what the role of the FDIC is. You can go through it. Broker deposits, a lot of the payments companies, I alluded to this earlier. So if you're a fintech out there that's focused on payments and you have a large volume of payments going through your technology, that is beyond attractive to various banks. So the broker deposit rules in 2019 were updated with the intended purpose of looking at it through the lens of fintechs that are out there. So like we need again to update the regulations to adopt to a set of circumstances where you have something like a fintech or a payments fintech that's out there and can park those deposits at various depositories.
Craig, let's stop there for one moment. Clara, if you could give the attendees the second word for CLE credits, please.
Let's go with sandbox. Sandbox is the second word.
Thank you, Clara.
I like that, Clara, on the fly, just pulling it from the slide. So we do have various sandboxes. Again, the OCC has an innovation pilot program. The CFPB has a trial disclosure sandbox. Part of the problem here is that we have the state-federal fight, right? It continues. And, just because you get, a sign off from the CFPB, are you going to get that from your state regulator? Do we have a unified national sandbox coming soon? Well, we don't know, but we'll be on the lookout for that. But it is good to be aware that these options are out there. Again, a client that Rick and I have been working with might be entering the Florida sandbox for financial technology, just to see if what they're doing will fit under the state regulatory regime. I know Brad Rustin is working with various ISAs. It's less so fintech, but more showcases the ability of the CFPB to kind of work with the entities that are out there to kind of walk you through what the disclosure liability will be, or the disclosure should look like, because they haven't been contemplated yet under the current regs. FEDNOW, so going back to real-time payments, we also are trying to deploy that here in the US. So FEDNOW is the Federal Reserve's approach to it. The problem is it's not expected to launch until 23, 24, but you will have access to funds immediately. You will have instant confirmations. Again, some people in the US believe that this is currently out there, but it's not really. A lot of that risk of chargeback, or a lot of the risk of fraud, is put upon various parties depending on how you contract that relationship. The FedNow solution will only process request-to-pay transactions. Important to note that as well. And instantaneous access to balances with weekend and holiday clearing as well. So you will see payments or deposits processed every day of the year. And we're going to have to rewrite a host of a variety of regulations to address fraud and liability. Again, like, it's unclear as to who has that liability. Also out there is the clearinghouses, real-time payment network. They're building a payment network that will also provide payment access 24/7, 365. So this is like the VHS beta argument of the 80s, where we don't know which is going to win. So you have banks lining up with the clearinghouse. You have other entities looking forward to the FedNow solution, but we don't know which is going to be, universally adopted. So we're kind of looking at everything. Important to note some discrepancies here. The clearinghouse is currently push only, while the FedNow program has a request to pay feature. So you'll do push and pull payments on FedNow, but the clearinghouse will be push only. So we have seen some real-time payments deployed here in the US, very limited. JP Morgan allowed PayPal to do real-time payments. Again, you're contracting for the liability here, so I don't necessarily see this as adopted universally in the next 6 to 12 months, especially when you have FedNow and the clearinghouse out there coming out in the next year or two. But again, this is presenting problems for our clients, who are being offered real-time payment solutions from various fintechs and various fintech payment entities. our clients need to be aware, well, where does that liability stand? How are they doing this? And they really, 99% of the time, our clients don't have the subject matter expertise to understand how these payments are working. And that's part of the value add that we're presenting to them, saying, all right, we'll walk through it with you. We'll look at the contract, we'll vet them, we'll diligence them for you, and make you aware of some of the risks that you're taking on. And with that, we want to leave time for a few questions, but I think that brings us right up to the end, Rick. So anything you want to add?
No, before we close, I'd like to say thank you to all of the attendees for participating in this introduction to another aspect of FinTech or financial technology and regulation. I think as you saw from the presentation at Nelson Mullins, we try to stress that the tech is not oftentimes the hard part for the clients. The hardest part is trying to figure out how to fit their business of the 21st century into rules and regulations that were written when regulators were watching guys wear leather football helmets playing football back in the 1930s and 40s. So please keep in mind that as you're listening to this and as you're working through it in the future, and if you want to be involved with us or if you have questions as a client, please reach out to the folks that are on this last slide. We are happy to spend time with you off the clock learning about your business and trying to figure out how your business fits into the regulatory model of today. But with that, I'll turn it over to Claire to see, do we have any questions